All right. Well, welcome back. I am joined again here with Chief Investment Strategist Stephen Hanley, and we thought we would have a conversation about what's kind of going on here. We talk a lot about around the office about whatever financial decision anyone's facing. There is the emotional side of things, and there's the mathematical side of things. And usually, wherever we land, it's somewhere kind of in the middle. And some people may be more emotional driven, some people might be financially more mathematical driven, but trying to marry the two a little bit. We're finding right now we're hearing a lot of conversations on the more of the emotional side. So we want to acknowledge that, but we also want to offer some context as well. So, Steve, how you doing? First of all, and secondly, kind of yeah, just go ahead and kick us off with maybe a little perspective of where how we got to where we are, and maybe looking ahead just a little bit.
Yeah, obviously one of the reasons we're doing this take today is there's a lot of news. There's a lot of
Yeah.
headlines out there. There's a lot of moving pieces out
Mm-hmm.
there. It's natural, certainly if you're watching the news, to get a little bit emotional, I think, at this point in time. And, what we can say is for sure, the uncertainty of things has gone up.
Mm-hmm.
And in the short term, the possibility of outcomes for investments in general has gone up. And
Mm-hmm.
so we're well aware of that. And we've been working really hard in the last few weeks on things, circling the wagons, if you will, in different areas. And we wanted to communicate some of that today. But to start, really, to your question, to put this in perspective, I think it's important for us to always take a bigger view when we look at investments. We're investing for the long run. We're investing for 5, 10, or many, many more years
Yeah.
and decades than that. And so when we look at that, and I like looking over a 5-year window, over the last 5 years, you have the S&P up roughly 90%. You
Wow.
have the Dow Jones equity market up roughly 65%, and other indexes, other areas. But if you look at that, you say, okay, to get a 9% return, which would be pretty normal and in line with historical corporate profits, in the last 5 years, we should be up around 50, 53%.
Mm-hmm.
And so the equity markets are well ahead of that at the
Mm.
moment. We were a little pricey coming into the year. And so it's probably normal to some degree to have a decline to bring us back. That's just the way investments in the equity markets work. You have multiple steps forward, usually gets ahead of itself for a number of reasons, and then you have a pullback to bring things more in line. So we have expected this. We've
Mm.
mentioned we expected volatility to pick up. Last year, we started saying we really do think there will be a time. We never know exactly when that would happen, but
Mm-hmm.
something was going to happen to bring things more in line. And so that's where we're at today, is we still have a very long-term view, and we think this is all part of a more normal long-term cycle that you see things step back to a more normal equity pattern in line with corporate profits. So.
Yeah, and that's good to have that perspective. And you had mentioned a stat as well before we press record about a 10% correction, how often that happens in the markets. And so
Yeah.
regardless of the headlines, what are you, yeah, what was that you shared?
Yeah, well, it's important. Yeah, I mean, markets are barely down really even year to date. I mean, they had
Hmm.
a little run up, a little pullback. At this point, yes, from its high point, I think the S&P is down roughly 7%. But historically, about every 1.2 years, so almost every year,
Hmm.
you have a 10% correction in
Hmm.
equities. And so it's not, even in good time, really good times, it's not unnormal to see 10% corrections.
Yeah.
Now, of course, that creates emotions during those, and it's always hard to decipher, is this just a 10% correction, or is this really the beginning of something bigger, a recessionary style correction, which it certainly could be. And we are
Hmm.
seeing a lot of red flags, if you will. The signals we track, the things we look at do point towards perhaps we are in the midst right now of a recession. It's possible. Doesn't mean it could be a slowdown, it could be a recession. A lot of it will depend on how things shake out in different areas over the next couple months. But recessions do happen from time to time. And a lot of times recessions can be 15% pullback, 17, 20, 22. We can have recessions that aren't 50, 60% pullbacks like we saw in the Great Recession in '08. COVID was a pretty big pullback,
Mm-hmm.
37%. The tech bubble bursting. You think of the really bad ones, but then sometimes we forget about all the other pullbacks we've had in between that we just move past, and people, clients forget about. We've had a lot of really big 10, 20% style equity pullbacks, and that's just part of the investing cycle as we work through it.
Hmm. That makes a lot of sense. And what we find when we had these conversations, if some people are concerned, and that's totally fine to feel that way, where we kind of come back to is kind of putting it in context to their specific plan. So it's natural that equities or the stock market, the Dow Jones, S&P, all those things, those get the headlines, the daily headlines. Oh, the market's up and down, and it makes you maybe want to look at your account. And I think that we have to remind people that that's just in some cases, the equity position is a sliver of your overall portfolio. It could be, a bigger piece of the pie, but trying to put it in, what are your other income sources? Do you have money in the bank? Do you have money in bonds? Of the equities you do have, are they more volatile like a tech stock, or are they dividend paying companies? So it is one of those things that it's easy to get hyper focused on the headlines and feeling like it's going in one direction. And our where we often find ourselves is bringing people back to what is it in the context of your plan and staying the course for your plan. And Wall Street, they're not looking 5, 10 years down the road. That's right, Steve?
Yeah, the Wall Street is always looking about 3, 6, 12 months at most down the road. And so
Mm,
a lot of the activity you see is based on things they think are going to happen 3, 6 months. So you have these big moves. However, when we build a plan, to your point, Dave, I mean, we're addressing all of this on the front side of building the plan so that we have our general asset classes, diversification, everything in place. So when this happens, we know we have some risk boundaries, we have some thresholds, we have diversification to try and withstand whatever happens in the market. And so that's why we build it ahead of time. And it's why we are hyper focused on the plan component and what does the plan look like and what do we need to accomplish, a lifetime plan for clients. So we're looking out 5, 10 years. Wall Street's looking out 3, 6 months
mm,
oftentimes. And so
hmm.
that's really our advantage in times like this is we maintain a focus, a hyper focus on 5 years from now, what we think is going to happen, not
Hmm.
trying to make decisions on 3 and 6 months from now. And so one of the, maybe a good analogy is like if you needed your kid to get amped up for a party because your kid's a little tired, Wall Street hands them a thing of Mountain Dew, right? Your kids, you've accomplished your objective, right?
Hmm.
Or maybe you want the kid to, go to bed. You hand them a sleeping pill, right? Neither of those are really good health decisions for the
Right.
child, right? But they will make you feel good temporarily. And we see a lot of that kind of reaction in Wall Street over short periods of time. We're saying, no, we want to build a portfolio for the long term. And then what happens in the market in the short term is we get these disruptions and dislocations. And that's when we can oftentimes add even more value. So we think there's tons of value in having a well-constructed plan and portfolio. We remain focused on the plan, but we don't sit here and do nothing, right?
Mhm.
Our answer isn't just stick it out. Like
Yeah.
we think we want to add a lot of value in this process. And so when we're journeying down this road and we see things being thrown in front of us, we will adjust and take advantage of this situation. And so if we have 2 companies in the equity markets and we already have gone through the last couple of weeks, we're stress testing the portfolios. And I have so much fun during this time, not because I like seeing markets go down or any accounts lose any value, but what I do see is I see companies starting to get cheaper. And I can go through and plot my plan well ahead of time before we have any real price dislocations, so
Hmm.
that if they occur, if we do see a continuation of declines, we stand ready ahead of time. This is your plan. Here's what you own. If this happens and things get this low, I want to buy these companies on sale or on clearance. And
Mm-hmm.
so we're ready to act. You'll see more activity in times like this from us than any other time, because when things go on sale, that's when we want to reshuffle the deck. We want to redo things so that we know when things rebound, and we're looking out again 5 years, that we can harvest that opportunity for clients always to meet their goal within their
Mm-hmm.
risk thresholds. If they're more conservative, they already are well balanced outside the equity markets. But for all clients, we're looking at this. How do we continue to meet your goal? And is there anything being given to us in these dislocations that can help us get there faster or more securely, that we want to take advantage of? So that's what we're doing right now. So
Okay, that's great stuff. And as we wrap up here, I guess if we could leave people with some, maybe practical advice. I have a couple thoughts, but I'm curious if you have anything that maybe that you've already shared or something that you like to leave folks with.
yeah, I mean, remain long-term focused is always the biggest thing. We know over the, as long as economies are going to grow, and I'm not saying there can't be times and disruptions and
Hmm.
politics and all sorts of things that can create scary moments. But I do believe our system, the system will stay intact. It will adjust, it will self-correct, and over the long term, we'll get to where we need to get to. And so you trying to keep emotions at bay, stay really focused on the long term is key. And then if we do have a really big correction and you have excess outside cash, which some clients do, they've built
Hmm.
up, and they've asked us from time to time in meetings like, hey, let us know, if you see like a really good opportunity to invest this money. We're not there right now, but if you have that rainy day fund where you're like, you're not going to use it and you think it's a great time, that time might be coming. And so I think, keeping an eye out for, as things, if they do get a little worse and you're in a good position to continue adding. If you are adding, keep adding to your plan. If you're pulling money from your plan, you're already invested in a way that's creating income to sustain
Hmm.
that. And so even if the market pulls back, we're keeping really good tabs on the income that's coming in to support your needs and your income. So we're not as worried, whether the market is up here or down here. The actual dollars coming out to support your income should be the same and hopefully rising over time. So we're focused on all of those type of things. And I think that's the right focus for a client to have, is just that long-term perspective, trying to keep emotions as low as possible. But if they do get too high, give us a call and we can walk you through even more details to hopefully bring your confidence level up over the long term. So
That's really good. And a couple things I'll add is, it's sometimes easy to get lost in the vortex of maybe you're scrolling through your phone, or if maybe you had the news on just in the background throughout the day to kind of be, I don't know, sucked in to some of that emotionally driven thing. So I think it's okay to maybe, take a low information diet for a little while. Go outside for a walk or meet a friend for coffee. Not suggesting to bury your head in the sand, but some of that can just add to the anxiety. And then I'll also just say that we're here. If you work with a financial advisor, this is our time to really put that context, revisit the plan, make sure that it's still in alignment with your goals, in alignment with your emotions, your approach. And if you don't have a financial advisor, we'd be happy to talk in more detail about those specific things. So every plan is unique. Every person's risk tolerance is unique, and so just trying to marry those two things and have that long-term approach. So, with that, Steve, thanks again for your time, and I look forward to the next conversation.
yeah, same here. Thanks, Dave.
Yep.